Institutional investment in cryptocurrency has become one of the defining shifts in modern finance, transforming digital assets from a niche experiment into a mainstream component of global portfolios. In the early years of Bitcoin, adoption was driven mainly by retail investors, technology enthusiasts, and those skeptical of centralized financial systems. Cryptocurrencies were dismissed as speculative bubbles or tools for illicit activity by banks and regulators, and their extreme volatility reinforced the perception that they could never play a serious role in professional finance. Yet, over the past decade, and especially in recent years, the tide has turned as hedge funds, asset managers, corporations, pension funds, and even governments have begun allocating capital to digital assets. This wave of institutional involvement has provided liquidity, credibility, and infrastructure that are helping reshape not only the cryptocurrency market, but also the broader financial system. A major reason institutions are entering the crypto space is diversification. Traditional asset classes, such as equities, bonds, and commodities, often exhibit correlated performance, particularly during economic downturns. Bitcoin, with its fixed supply and decentralized nature, has been positioned as a digital gold and potential hedge against inflation, currency debasement, and systemic risks. While Bitcoin's correlation with traditional assets fluctuates, its long-term appreciation and unique profile make it an attractive candidate for portfolio diversification. For institutions, even a small allocation to crypto can enhance risk-adjusted returns, given the sector's growth potential. Asset managers like Fidelity and BlackRock have introduced crypto products to meet this demand, and large firms such as Grayscale have attracted billions into Bitcoin and Ethereum trusts, creating bridges for traditional investors to access digital assets. Another important factor fueling institutional involvement is the rapid improvement in market infrastructure. In the early days, securing and trading crypto assets required handling private keys, unregulated exchanges, and complicated processes that were unacceptable to compliance-driven institutions. Today, the ecosystem offers regulated exchanges, insured custodial services, and financial products that align with institutional requirements. Firms such as Coinbase Institutional, Gemini, and Anchorage provide professional custody solutions, while regulated futures markets on the Chicago Mercantile Exchange, CME, and exchange-traded funds, ETFs, in certain regions allow for indirect exposure. These innovations reduce operational risks and regulatory hurdles, giving institutions the confidence to step into a once-fringe market. Corporate adoption has also accelerated the legitimacy of cryptocurrency. When Tesla announced its $1.5 billion Bitcoin purchase in 2021, it set a precedent for publicly traded companies to hold digital assets as part of their treasury management strategy. MicroStrategy, under Michael Saylor's leadership, went even further by investing billions in Bitcoin, promoting it as a superior store of value compared to cash. Payment giants like PayPal and Square integrated crypto services into their platforms, signaling mainstream demand. These moves created a domino effect, encouraging other boards, CFOs, and investors to consider cryptocurrency not just as a speculative asset, but as a strategic reserve or growth investment. Hedge funds and venture capital firms have played a crucial role in deepening institutional presence. Dedicated crypto hedge funds have multiplied, with many traditional funds adding digital assets to their strategies to exploit inefficiencies in a still-maturing market. Venture capital investment has also surged into blockchain startups, decentralized finance, DeFi projects, and Web3 platforms, betting not only on digital currencies, but also on the underlying technology's transformative potential. This influx of capital has fueled innovation, accelerated adoption, and reinforced the sector's credibility in the eyes of global finance. Regulation remains a double-edged sword, but is central to institutional confidence. While global regulatory approaches vary, progress has been made. In the United States, the Securities and Exchange Commission, SEC, continues to debate whether certain tokens qualify as securities, but Bitcoin has been widely accepted as a commodity. Europe has advanced its markets in crypto assets, MiCA framework, aiming for consistent oversight across member states. Although crypto purists often view regulation as restrictive, for institutions it represents clarity, compliance, and risk management. Pension funds, insurance firms, and sovereign wealth funds require such certainty to justify allocations, and the evolving regulatory landscape is gradually enabling larger flows of institutional capital. The impact of institutional adoption has been significant. Market liquidity has improved, spreads have narrowed, and price discovery has become more efficient. Institutional-grade products like futures, options, and lending platforms have created opportunities for hedging, yield generation, and portfolio management, aligning crypto with traditional financial strategies. At the same time, the entrance of major players has sparked concerns that the decentralized ethos of cryptocurrency could be diluted. Digital assets were born as a challenge to centralized systems, but as Wall Street firms, multinational corporations, and governments increase their influence, questions arise about whether the original vision of financial freedom, transparency, and inclusivity can survive alongside institutional dominance. Volatility remains one of the greatest challenges despite institutional adoption. Cryptocurrencies can still experience double-digit price swings within days, unsettling risk managers and regulators. Events such as the collapse of FTX, the downfall of Terra Luna, and bankruptcies of lending platforms like Celsius and Voyager underscore the risks of fraud, poor governance, and systemic contagion in the industry. These crises highlight that while infrastructure has matured, transparency and oversight remain essential for long-term institutional trust. Nonetheless, the resilience of Bitcoin and other major cryptocurrencies through repeated market downturns continues to demonstrate their staying power. One of the most anticipated milestones for institutional adoption is the approval of spot Bitcoin ETFs in the United States. While Canada and Europe have already launched such products, U.S. regulators have been hesitant, approving only futures-based ETFs so far. A spot ETF would allow institutions, retirement accounts, and retail investors to gain direct exposure through traditional brokerage platforms, unlocking potentially billions in inflows. Many analysts view this as a turning point that could drive a new wave of adoption, much like the introduction of gold ETFs revolutionized access to precious metals markets. Looking ahead, institutional interest will likely expand beyond Bitcoin. Ethereum, with its smart contracts and decentralized applications, has emerged as a leading platform for DeFi, NFTs, and Web3 innovation. Institutions are not only buying Ether, but also exploring staking, where participation in network security can generate yields. Interest is also growing in Layer 2 scaling solutions, blockchain interoperability projects, and tokenized real-world assets such as real estate, equities, and commodities. Tokenization holds particular promise as it enables fractional ownership and liquidity for traditionally illiquid assets, aligning closely with institutional goals of efficiency and global market access. Environmental, social, and governance (ESG) considerations will also influence institutional strategies. Bitcoin's proof-of-work model has been criticized for its energy consumption, raising concerns for ESG-conscious funds. Ethereum's move to proof-of-stake has reduced its energy use by over 99%, making it more attractive to sustainability-focused investors. Institutions may pressure the broader industry toward greener solutions, driving innovation in renewable-powered mining and energy-efficient blockchain designs. Their influence could help reshape narratives around crypto's environmental impact, balancing growth with responsibility. In conclusion, institutional investment in cryptocurrency is not just a passing trend, but a transformative force reshaping global finance. The involvement of large financial entities has brought liquidity, legitimacy, and maturity to crypto markets, while also challenging the industry to balance decentralization with professional oversight. Opportunities in diversification, innovation, and tokenization are immense, but so are challenges related to volatility, regulation, and sustainability. As institutions continue to deepen their participation, the future of cryptocurrency will be defined by the balance between its disruptive origins and its integration into traditional finance. What is clear is that digital assets can no longer be ignored by the financial establishment, and institutional investment will remain at the heart of their evolution for years to come.